The cryptocurrency market is no longer the exclusive domain of tech-savvy early adopters and institutional giants. Retail investors, everyday individuals, are flocking to this new asset class in droves. Driven by a combination of factors, including increased media attention, the accessibility of online trading platforms, and the potential for high returns, these new entrants are reshaping the face of the crypto market. This influx of retail investors is democratizing access to what was once a niche market. It signals a fundamental shift in how individuals view and interact with finance. The barriers to entry have never been lower. User-friendly exchanges and mobile apps have made buying, selling, and trading cryptocurrencies easier than ever before. This accessibility has been instrumental in attracting a new generation of investors, many of whom are digital natives comfortable with the online world. Retail investors are drawn to the potential for outsized gains that cryptocurrencies offer. The allure of getting in early on the next Bitcoin or Ethereum is a powerful motivator. However, this surge in retail participation also presents challenges. Many new investors may lack the experience and financial literacy to navigate the volatility and risks inherent in the cryptocurrency market. It is crucial for these investors to approach this new asset class with caution, conduct thorough research, and understand the importance of risk management. The rise of the retail investor is a testament to the growing appeal and accessibility of cryptocurrencies. It is a trend that is likely to continue. The cryptocurrency market is in constant flux, a dynamic landscape shaped by technological advancements, regulatory developments, and macroeconomic trends. Recent market trends reflect this volatility, offering both opportunities and challenges for investors. One notable trend is the increasing market capitalization of the overall cryptocurrency market. Despite recent fluctuations, the total market cap remains significantly higher than in previous years. This growth underscores the growing acceptance and adoption of cryptocurrencies as a legitimate asset class. Trading volume, a key indicator of market activity, also remains substantial. High trading volumes suggest continued interest and participation from both retail and institutional investors. Another significant trend is the rise of decentralized finance, or DeFi. DeFi platforms built on blockchain technology aim to revolutionize traditional financial services by offering decentralized alternatives to lending, borrowing, and trading. The DeFi sector has experienced explosive growth, attracting significant investment and innovation. However, it also faces challenges including security risks and regulatory uncertainty. Understanding these trends is essential for investors seeking to navigate the ever-evolving cryptocurrency market. Bitcoin and Ethereum, the two largest cryptocurrencies by market capitalization, continue to exert a significant influence on the broader market. Bitcoin, often referred to as digital gold, remains the most recognizable and widely traded cryptocurrency. Its decentralized nature, limited supply, and potential as a store of value have attracted investors seeking an alternative to traditional assets. Ethereum, on the other hand, has emerged as a leading platform for decentralized applications, or dApps, and smart contracts. Its native cryptocurrency, Ether, powers transactions and fuels the Ethereum ecosystem. Ethereum's versatility and potential for innovation have made it a favorite among developers and investors alike. Recent price movements in both Bitcoin and Ethereum have been volatile, reflecting the overall market sentiment. Bitcoin has experienced both sharp rallies and corrections, while Ethereum has seen significant price swings driven by factors such as network upgrades and DeFi adoption. Despite this volatility, both cryptocurrencies remain key players in the crypto space. Their performance and future trajectory continue to shape the outlook for the entire market. The recent cyber attack on Coinbase, one of the world's largest cryptocurrency exchanges, serves as a stark reminder of the security risks inherent in the digital asset space. The attack, which resulted in a significant financial loss for the company, exploited vulnerabilities in Coinbase's systems and highlighted the importance of robust security measures. The incident has raised concerns among investors about the safety of their funds on centralized exchanges. It underscores the need for exchanges to prioritize security and implement measures to protect user assets from cyber threats. In addition to security concerns, the cryptocurrency industry also faces ongoing regulatory challenges. The recent rejection of Ripple's proposed settlement with the U.S. Securities and Exchange Commission, or SEC, highlights the uncertainty surrounding the regulatory landscape. The SEC's lawsuit against Ripple alleges that the company's XRP token is an unregistered security. The outcome of this case could have significant implications for the broader cryptocurrency market, particularly for other altcoins that may be deemed securities. Navigating these security and regulatory challenges is crucial for the long-term growth and stability of the cryptocurrency market. Section 5. The Institutional Wave. A tide that lifts all boats? The entry of institutional investors such as hedge funds, asset managers, and corporations has been a major development in the cryptocurrency market. These institutional players bring with them significant capital, expertise, and legitimacy, further solidifying the position of cryptocurrencies as an investable asset class. Institutional interest has been driven by a number of factors, including the potential for portfolio diversification, the search for yield in a low-interest rate environment, and the growing acceptance of cryptocurrencies as a hedge against inflation. The involvement of institutional investors has contributed to increased market liquidity and price stability, making it easier for investors to enter and exit positions. Their participation has also led to the development of more sophisticated trading products and services, such as Bitcoin futures and ETFs, providing investors with more options to gain exposure to the crypto market. However, institutional involvement also presents potential risks. The large-scale buying and selling activities of these players can exacerbate market volatility. Their investment strategies and risk tolerance may differ significantly from those of retail investors. The influence of institutional investors on the cryptocurrency market is undeniable. Their continued participation is likely to shape the market's future trajectory. Macroeconomic factors play a crucial role in shaping investor sentiment and driving market trends in the cryptocurrency space. Global economic uncertainty, geopolitical events, and monetary policies can all influence the price movements of cryptocurrencies. One significant factor is inflation. As fiat currencies lose purchasing power due to inflationary pressures, investors often turn to alternative assets, such as gold and cryptocurrencies, as potential hedges against inflation. Bitcoin in particular has gained recognition as a potential digital gold due to its limited supply and decentralized nature. Geopolitical instability and uncertainty can also drive investors towards cryptocurrencies. During times of political turmoil or economic sanctions, investors may view cryptocurrencies as a safe haven asset, providing a degree of protection from traditional financial systems. Monetary policies such as interest rate hikes or quantitative easing can also impact the cryptocurrency market. Loose monetary policies characterized by low interest rates can make riskier assets, including cryptocurrencies, more attractive to investors seeking higher returns. Understanding the interplay between macroeconomic factors and the cryptocurrency market is essential for investors seeking to make informed decisions. Technical analysis, a method of evaluating investments by analyzing past market data, plays a crucial role in understanding price movements and identifying potential trading opportunities in the cryptocurrency market. Support and resistance levels are fundamental concepts in technical analysis. They represent price points where an asset's price has historically struggled to break below support or above resistance. Support levels act as a floor, where buying pressure is typically strong enough to prevent further price declines. Resistance levels, on the other hand, act as a ceiling, where selling pressure is typically strong enough to prevent further price advances. Traders and investors use support and resistance levels to identify potential entry and exit points for their trades. For example, a trader might look to buy near support levels, anticipating a price bounce, or sell near resistance levels, anticipating a price pullback. These levels are not absolute guarantees of future price action. They provide valuable insights into market psychology and potential price turning points. Understanding support and resistance levels can help investors make more informed trading decisions in the volatile cryptocurrency market. Market sentiment, the overall attitude of investors towards a particular asset or market, plays a significant role in driving price movements in the cryptocurrency market. Understanding market sentiment is crucial for investors as it can provide insights into potential price trends and market turning points. Several indicators can be used to gauge market sentiment. Social media sentiment analysis, for example, tracks the overall tone and sentiment of conversations about cryptocurrencies on platforms like Twitter and Reddit. A predominantly positive sentiment suggests bullishness, while a negative sentiment suggests bearishness. The Fear and Greed Index is another popular indicator that measures market sentiment based on factors such as volatility, market momentum, and social media trends. A high Fear and Greed Index reading suggests excessive optimism and potential overvaluation, while a low reading suggests excessive fear and potential undervaluation. Investor psychology also plays a crucial role in shaping market sentiment. Emotions such as fear, greed, and hope can influence investment decisions. Understanding market sentiment and investor psychology can help investors make more informed decisions. It allows them to gauge the overall market temperature and potentially identify opportunities where sentiment may be out of sync with underlying fundamentals. The cryptocurrency market stands at a pivotal juncture, poised for continued growth and mainstream adoption. The influx of retail investors, coupled with increasing institutional interest, is reshaping the landscape, driving innovation, and challenging traditional financial systems. The future of crypto is likely to be shaped by several key trends. One trend is the continued development and adoption of blockchain technology. Blockchain, the underlying technology behind cryptocurrencies, has the potential to revolutionize industries beyond finance, including supply chain management, healthcare, and voting systems. As blockchain technology matures and becomes more widely adopted, it is likely to create new opportunities and use cases for cryptocurrencies. Another trend is the increasing regulation of the cryptocurrency market. Governments and regulatory bodies around the world are grappling with how to regulate this nascent asset class, balancing the need for consumer protection with the fostering of innovation. Clearer regulatory frameworks will provide much-needed certainty for businesses and investors, promoting further growth and adoption. The future of crypto is also likely to be shaped by the evolution of existing cryptocurrencies and the emergence of new ones. Bitcoin and Ethereum are likely to remain dominant players, but other cryptocurrencies with unique features and use cases may emerge as well. The cryptocurrency market is still in its early stages of development. It is characterized by volatility, risk, and significant growth potential. The rise of the retail investor is democratizing access to this exciting asset class, potentially paving the way for a more inclusive and decentralized financial future.